What's up, everybody? Wednesday, July 21st. So we had 2 big days of market rebound. All right. I mean, the S&P retraced most of the Friday, Monday decline. I think NASDAQ pretty much retraced all of the Friday, Monday decline. Dow almost there. Russell 2000, not quite, but it still had a good day. I think it was up around 1.6%, something like that. I'll be honest, I was not expecting this. As you know, I've been talking about the deceleration in the fiscal flows. That is still happening. That is still happening. As a matter of fact, the 10-day average of daily flows is now down to the lowest level in 3 weeks, and that low is close to the slowest daily average we have seen so far this fiscal year. So, that's ongoing. That's still happening. So one theory I have for the very sharp rebound, yesterday the Fed did $848 billion in reverse repos. Those were one-day operations. Today it came in again. It did $886 billion of reverse repos, basically just, I guess, rolling over those repos from yesterday, adding a little bit, about another 40 billion onto it. So why is that, impactful? Let me explain. Again, we're in this situation where all the reserve additions to bank balance sheets, that's constraining the banks. It's either constraining them in terms of their lending, it's constraining them in terms of their accumulation of other types of assets, maybe risk assets, maybe trading assets. And that's where I think this sharp rebound has its explanation. So the Fed coming in doing almost $1 trillion, right? 886 billion. We are going to see, when we see the numbers tomorrow, when the Fed releases its H41 weekly release, I'm telling you, we're going to have another week where we'll see the numbers of a very big reserve drop. Now, I went back and I checked, because it just makes sense that, when this cash is swept off bank balance sheets, it gives the banks ability to, either up their lending or acquire other assets. And, when this happened the last time, in the 2 weeks ending June 30th, right? So you had the week of ending June 23rd, the week ending June 30th. And I did a video about this. That was over a 400 billion reserve drain in that 2-week period. Remember, I was saying they're unprinting money. They're unprinting it. It was really bullish. It was really bullish for the market, because, when I looked at the numbers from the H8 Fed release in those weeks, they were big buyers of trading assets. What are trading assets? Those could be derivative contracts. They could be, S&P futures. They could be, all that kind of stuff. Currencies. So, yeah, there's a correlation there. So we're seeing it happen again. Now, these things are pretty much technical, okay? So technical in the sense that, the Fed comes in, does these operations to, sweep some of this cash off of the bank balance sheets, because, they're under these regulatory constraints, the supplemental leverage ratio and stuff like that. So, I mean, these are Fed operations designed to temporarily, kind of move things through. I mean, the whole scenario here is like a Rube Goldberg crazy contraption, because, you still have the Treasury drawing down its account at the Fed, so that's adding reserves. You got the Fed itself buying 120 billion in assets a month when it's totally unnecessary here and just adding to the problems. But like I said, I think the Fed is deathly afraid to taper its asset purchases, because, it sees that as stimulus And so does everybody else, even though it's not. And if they were to stop doing that, even if they were to announce they were going to stop doing that, everything would go into a frenzy, and I don't think Powell wants that. I don't even know how he views that. I mean, I think he views that as stimulus. So it's this crazy monetary, contraption that they have going on now. You got the debt ceiling coming up. Treasury is supposed to draw down its account at the Fed to, I think, a $300 billion. They're still at $647 billion at last look, which was, yesterday's number. They got, and that's coming up next week. The debt ceiling is coming up next week. So unless Yellen knows something politically that it's going to get suspended or raised, which I doubt she knows, because the Republicans in the Senate are not giving any indication that that is going to happen. I mean, we're leaning more towards, Treasury having to move into these extraordinary operations to make payments, like I was talking about yesterday. Mnuchin had to do that too until they finally work something out. And I think the Senate goes on recess in August. So, I mean, if they don't do something by next week, then, nothing's going to happen until September. And by then it's going to, we're talking about the end of September. So it's going to get really wild. But there's a potential here, even, I'll say this, even in spite of the deceleration in the fiscal flows. And that's pretty clear right now. I'll be honest with you. You may have a situation here where, the Fed just continues to sweep this cash onto its own books. The banks continue to buy their trading assets or whatever, maybe increase some loans. And you get a market melt up. All right. Now, the only thing, now I'm starting to think that the only thing that would preclude that, and again, if it goes in that direction, you got to understand this is all technical in the sense of, Fed short-term operations to alleviate the pressure on the banks with this whole reserve situation. But the overarching fundamental, the overarching picture right now is one of slowing fiscal support. So what I was just about to say, the only thing that might counteract this or change the dynamic here would be if we start to see some weaker economic numbers come in. All right, if that happens, then it could trigger a negative response. All right, but we need to see that happen. Today, let me just quickly make mention of the EIA petroleum report. We had a 2.1 million build in crude inventories. That was the first time in 9 weeks we saw crude inventories build up. The last 3 weeks straight, the last 3 consecutive weeks have seen a decline in crude oil demand by refiners. Refiner inputs are down 3 weeks in a row. All right. Gasoline demand was kind of unchanged. Distillate demand was up strong, but it was up strong from low levels. Crude oil exports were weak. Product exports were pretty steady, and they're still at pretty high levels. So it was kind of a mixed report. I would say that crude oil demand on the part of refineries and weak exports and a build in inventories, and I think it was a 14-month high in crude imports. That's a little bit bearish, I think. But the oil rally today with the equity market. So anyway, a lot going on here, and it's going to get really wild, believe me. All right, that's it for today. See everybody tomorrow. Bye-bye.